This scam promised student loan forgiveness, charged upfront fees, and left victims deeper in debt. Across the US, UK, and parts of Europe, borrowers were told they qualified for fast-track relief programs. Scammers claimed affiliation with government agencies and official loan servicers. Victims were asked to pay fees ranging from hundreds to thousands of dollars to unlock forgiveness. In reality, no such program existed, and the payments were never applied to any loan balance. Investigations revealed that millions were collected through these schemes, with some estimates reaching billions globally. In one case, companies were banned after falsely enrolling borrowers into programs and pocketing their payments. The scam expanded by exploiting confusion around real relief programs and policy changes. What made it effective was simple. It targeted people already under financial pressure with the promise of immediate relief. Student loan systems became complex, with multiple repayment plans, servicers, and policy changes over time. Borrowers often struggled to understand eligibility for relief, consolidation, or forgiveness programs. Announcements of new policies created waves of uncertainty and urgency among borrowers. At the same time, many individuals were actively searching for ways to reduce or eliminate their debt. This created a demand for simplified solutions that promised faster outcomes. In several reports across the US and parts of Europe, borrowers relied on third parties for guidance. The distinction between official programs and private services became unclear. Data from prior loan applications and inquiries provided potential targets for outreach. This environment created an opening where relief could be sold as a service rather than verified through official channels. The scam often began with calls, emails, or ads claiming eligibility for immediate loan forgiveness. Messages referenced recent policy changes or limited-time programs to create urgency. Callers presented themselves as advisors, government representatives, or loan servicers. Victims were told they qualified for reduced payments or full forgiveness after a simple process. In several cases across the U.S., borrowers were directed to enroll quickly to secure their spot. Upfront fees were requested to begin processing or to lock in the program. Payment methods included direct transfers, recurring plans, or service subscriptions. At this stage, the process appeared official, and victims believed their loans were being handled. After enrollment, the scam shifted into ongoing fees and controlled communication. Victims were asked to provide personal details, account access, and authorization forms. In some cases, scammers took control of borrowers' accounts or changed contact information. Monthly payments were redirected as service fees instead of going toward the actual loan. Borrowers were told not to contact their loan servicer directly to avoid confusion. Progress updates were provided, but they were vague and not tied to real program status. In multiple reports, accounts fell into delinquency while victims believed they were being processed. Attempts to cancel services or request refunds were delayed or ignored. The system converted financial distress into recurring payments without delivering any real relief. As policy discussions and relief announcements increased, the scam expanded rapidly. New campaigns were launched around headlines, deadlines, and program updates. Scripts were adjusted to match current news, making offers appear timely and credible. In reports across the U.S. and parts of Europe, identical offers appeared under different company names. Lead generation systems collected borrower data and distributed it to multiple operators. Affiliate-style networks promoted services through ads, emails, and referral channels. Some operations handled thousands of borrowers simultaneously using standardized processes. What appeared as individual services was often a coordinated system built on confusion and demand. Patterns began to repeat across cases that later proved to be fraudulent services. Upfront fees were requested for programs that were officially free to apply for. Callers claimed urgency tied to deadlines that could not be independently verified. Borrowers were discouraged from contacting official loan servicers directly. Access to accounts was requested under the pretext of managing the process. Payment structures included recurring charges unrelated to actual loan repayment. Company names changed frequently or lacked verifiable registration details. Regulators noted repeated complaints tied to misleading relief claims. The issue was that these signs were often recognized only after payments had already been made. As complaints grew, regulators began connecting cases across multiple companies and regions. The Federal Trade Commission led actions against firms charging illegal upfront fees for loan relief. Investigations revealed scripts, call centers, and sales funnels reused across different brand names. Financial records showed payments routed into accounts linked to the same operators. In several cases, companies were ordered to shut down and refund millions to affected borrowers. Data analysis indicated that thousands of individuals were enrolled into programs that provided no real benefit. Some operations continued under new names after enforcement actions were taken. Coordination between agencies increased to monitor emerging variants of the same scheme. Estimated losses reached hundreds of millions of dollars across multiple years. The investigation confirmed a system built on misinformation, pressure, and recurring payments rather than actual debt relief. What this exposed was a gap between complex financial systems and how people seek help. When processes are difficult to understand, shortcuts become easier to trust. Borrowers were not buying relief, they were buying clarity and certainty. The system allowed third parties to position themselves between individuals and official programs. What failed was not the existence of relief options, but how they were communicated and accessed. Even informed borrowers could be misled when urgency and authority were combined. Experts now emphasize using official channels and verifying any service that requests payment. The broader lesson is clear. When money is owed, paying for shortcuts often creates deeper loss.